Welcome to the weekly recap for the liquidity source. There's a lot of things that I think, it's going to help educating potential clients and also people out there looking to invest in real estate. So what kind of advisor would I be without explaining some of these things? I think it's important to know.
Why do banks use DSCR?
It's a great question. So DSCR, for people that may not know unless you're like an intense investor or a developer, means debt service coverage ratio. The banks use it because it measures the ability of a borrower to use their operating income, which will tell them how much they can lend them in order to cover their debt obligations. To make that in a little simpler terms, the banks will lend the person a certain or party a certain amount of money based on what the operating income throws off. And that operating income is what you call the net operating income. So they take a coverage ratio, which usually some banks are 1.20, some banks are 1.35. If you wanted to figure it out, you could just take your net operating income and divide it by 1.20 or divide it by 1.35. That'll be the maximum a bank's going to lend you on that deal. So they have these coverage ratios because who knows what happens during the time that you have the loan. It's a major tenant could leave the premises, all kinds of things. So they make sure they're always covered in case of events. So it's very important. First of all, the banks also, they take the net operating income and first they take a vacancy management fee, which is usually between 5 and 10%. And then they take the debt service coverage ratio that's usually 1.20 to 1.35. And that's the maximum they're going to lend you on an annual basis. So this is coverage for any problems that may occur during the time of the loan and make sure that the bank's in good financial health and you're in good financial health in order to maintain those payments. That's really the answer. So vacancy management is also a coverage ratio. The banks are worried that what happens if somebody just normally comes to the end of their term in a lease and they need 3 or 4 months to get another tenant in. So they want to have a certain percentage for this vacancy. And God forbid there's a default. The bank wants to know that there's a management fee because this way they'll be able to run that business if necessary. When doing the debt service coverage ratio, they also look at the global cash flow, because remember this is a great example. This happened to us actually, where a person goes out to purchase a property and the debt service coverage, everything's great about this property, but when they looked at their global cash flow, maybe they're operating because one of the buildings is not doing well at all. They may have a debt service coverage overall of 1.0. That does not work for the bank. That means all the operating income that's coming in, all of it's going out to pay debt. So when you come with that new piece for the bank to lend on, they may say no because your overall global cash flow, all your properties, does not have the proper debt service coverage ratio. So that ratio is important on all levels.
What are some examples of contingent liabilities?
So the bank needs to know what type of exposure they're looking at when they're looking at a potential loan given to a group of people or to an individual. So they'll check things like personal financial statements and check global cash flows to find out what kind of personal liabilities exist. So what do I mean by that, personal liabilities? Well, they may have signed personally on other loans, and how many loans have they signed on and how much in dollars? This shows the potential of income lost over a long period of time. Doesn't mean they're going to lose it, it just shows the exposure that the bank is looking at. That's a large element, probably the biggest element. The second largest would be potential lawsuits, which in the personal financial statements they always ask. Any litigation going on? They want to know. They want to know what their exposure is. So this is very important, and there's a couple solutions to monitoring and helping the individual on the contingent liability. One would be non-recourse. So whenever you can possibly get a bank to do non-recourse, that's always helpful because that's not going to be considered a contingent liability because you didn't sign personally. The only exception to that would be fraud or something that somebody did improper, which they have these what they call bad boy clauses. So other than that, it remains non-recourse. The other element that they could possibly help themselves with is doing a Springer mortgage. And a Springer mortgage, you're not going to have the liability for the global cash flow, but if the property goes into default, then that would be a liability that they would have to look at. So these things are very important for the banks, and they always want to know your outstanding contingent liabilities, and these are a couple ways that you can get them in a better sense of having your own liability in these deals. There's a couple solutions to helping one with their contingent liabilities. One solution would be try to get non-recourse financing, which means you're not liable, you're not personally liable. And that happens in a lot of cases, especially if you're strong and if you're doing things like multifamily. The second, of course, you can't help it if you have litigation, but if you have litigation, you have to show that to the bank also, so hopefully you don't have an exposure, but that also could be helped by getting a letter from the attorney minimizing what that exposure is. You could have $1 million litigation, but your exposure may be $100,000, and a lawyer can help you get that, so that's important. The other thing you could possibly do is ask the bank to do a Springer mortgage, which means they're not going to count this as a contingent liability unless you default, and then that would kick in. So these are some solutions to these things, and any of this makes sense, you'd like to discuss it or with me, I think you should reach out.
How is the closing date in a real estate transaction defined?
Okay, so every contract or any sale always has a provision set giving a date for the transaction to close, and also it's the day that it transfers title. So it's a very important date when you're setting up a deal and setting up your closing.
How can you ensure the transaction is completed by a certain date?
So that's a great question. What happens is in normal deals, there's always an easy out for an adjournment. Maybe your wife was having a baby, maybe somebody took ill, maybe the property that you had to close on first didn't close and you had a reason to get, to push the date out. And that's typical, and that's never a problem. The problem, or the way that somebody may want to ensure the closing, is to have what they call time of the essence. That is a drop dead date. And when you get to that date, if you don't close, there's a major default on the property. So that kind of ensures that you'll get that closing, and that's important. So because the person may want a time of the essence simply because they close on the property and they don't close on the next property by a certain date, they're going to lose their deal. So that's a drop dead date that everybody should consider. So whenever anybody goes to close a deal, they have to have a contract of sale, and that contract of sale always provides a provision for setting a date. Now, depending on what your needs are, you may be in the middle of a deal yourself and you need to expedite that closing. And if that closing doesn't happen, you may in fact even lose your deal, and that would be a problem. So at some point you're going to put a time of the essence into this, because that time of the essence is a drop dead date. And if they don't close on that date, there's a major default there. So you have to consider that if you want to expedite the closing, to make sure that that won't just be adjourned, because normal request for adjournment is something that's typically done, and you may have a reason that you need it expedited. So consider time of the essence in all cases.
Okay, we're rolling.
So I hope you guys enjoyed and liked this video that we just did, and we plan on doing a lot more, and I'm really anxious to hear from you. So if you have any questions or comments, please drop it in the comment section, and we're going to get back to you and answer it, and looking forward to a long relationship here.